Assalamu alaikum friends. So welcome to the day 2 of AFM revision crash course for September 2021. Today's topic is investment appraisal. A very important topic. Why? Because you might get this question as a 50 marks question in section A, which is most probably the case, or you might get this as a 25 marks question in section B in question 2 or 3. But mostly by through my experience and also what I have seen in the past papers, investment appraisal mostly comes as a 50 marks question in section A, so you have to be prepared for this. Now, what are the topics that we are going to cover in investment appraisal? Let us go through the topics that we are going to cover today. Starting with the past exam history. Okay, please be aware of the latest past paper. What are the changes? Because in this video it includes only till December 2019. Okay, so December 20 and 21 are not included. Please make sure that you go through them. Okay, again, please avoid spotting questions and you're predicting that you are going to get these questions based on don't do some past paper analysis and all. Okay, because most of the students do these things even after giving warnings and advising them not to do. Students do this, and what happens, they only study for those area which they think are going to come. For example, they predict net present value comes after every 2 sittings. So they go back and check the trend. So there is no trend like that. It can come in any order. Okay. Next we have free cash flow. What are the free cash flows? Okay. Then we have inflation, because inflation affects your cash flows. Then we have DCF and taxation, discounted cash flow and taxation. Tax also impacts your cash flow. All those items which affects your cash flows will invest your investment appraisal. That's why we have to study that. One thing is inflation, the other one is taxation. Then we have capital rationing. What is capital rationing? You cannot invest however much you want, even if the investments are giving you positive net present value. There are some limits. So it could be internal, it could be external, that we are going to cover very briefly, not in detail. IRR, internal rate of return, how to calculate that, right? How to decide on a project whether to take or not based on IRR. Then we have another thing, modified IRR, that is known as MIRR. This is new to AFM, and you have to remember the formula. The formula is given for both. For IRR, you have to memorize. For MIRR, formula is given in your formula sheet. Then we have discounted payback period, and we have duration. And then finally, we have financial reporting and investment appraisal. So let's start with the past exam history. If you see, starting from June 2017 till December 2019, MIRR came once in December 2017. But you have to check for 2020 and 21 on your own to see MIRR came or not. But that does not mean that since MIRR came only once, it will not come, right? So please don't be relaxed and don't ignore it. You have to study. This is just for understanding. This is just for understanding that some topics are more important than over the other. Just to know that IRR also came in the same paper in question number 2 as MIRR. Usually IRR and MIRR are asked together because there's a comparison between these two method. Then we have net present value. Net present value, I can guarantee you that you will not get any past paper where net present value is not there. You will definitely get a question on net present value, either in section as a 50 marks question, either in section B as a 25 marks question, but you will get net present value, right? You might be given additional to that also, which is known as APV, adjusted present value. You have to be prepared for both. Okay, so this came 5 times as question 1 and question 2. That means question 1, if you see, that means 50 marks question, it came thrice, and twice it came as a question number 2. Duration, it came once in September 2019, and capital rationing, it came once in June 2018. Now we are moving towards our first topic, which is net present value. From exams focus, what is net present value? Net present value definition and all, you know, I don't have to give you the definition. It is your present value. That means all the present value of your cash inflows minus the initial investment. That is your net present value. So we know that if net present value is positive, we accept the project. If it's negative, we don't accept the project, and all those. And this is a commonly tested topic in your investment appraisal, which is net present value, often in section A as a 50 marks question. So now you know the importance of net present value. You definitely cannot go to that exam hall sitting for AFM without knowing net present value. Next, free cash flow. What is free cash flow? We all know what is cash and all know what is free cash flow. Free cash flow is something that you are not going to retain or you are not going to reinvest in the business. It is something free after you have deducted all your expenses, after you have deducted all your tax, everything is given, whatever cash is remaining in your hand, the free cash flow. You're not going to retain it, neither you're going to reinvest it in the business. And how free cash flows are calculated, you have to know it. Okay. Most of the time free cash flows are given, and this is the area where students make most of the mistakes are done in this area. How to calculate free cash flow? There are two. One is free cash flow to equity, the other one is just free cash flow to firm. Okay, there are differences between these two methods, so make sure that my videos are out there in detail. You can go out and check the difference between free cash flow to firm and free cash flow to equity. The difference is free cash flow to firm, that is known as the whole value, the value of the whole organization. Okay, from there we deduct the value of the debt. Okay, and when we discount free cash flow to firm or free cash flow, we discount it using cost of capital back. But when it's free cash flow to equity, the word equity says it is only for the equity holders. So what do? We discount that free cash flow to equity by cost of equity, not cost of capital. Okay. And when free cash flow to firm comes, we have to minus the debt, value of the debt. But when it's free cash flow to equity, we don't have to take it for the debt because it's already discounted, and whatever is there, it only goes to the equity shareholders. Okay. That's the only difference. Next, the formula is revenue minus cost minus investments. Okay. So when you're making that free cash flow, you'll be making that table starting with your sales, all your income, then you are deducting your cost, fixed cost, variable cost, whatever cost. There are so many other costs, okay, depending on the case study. Then we have investments, initial investment, working capital requirements, all this we deduct, and whatever is left is known as free cash flow. Okay, even if cash flow, free cash flow, same thing only. According for your exam point of view, cash flow or free cash flow, it is known as free cash flow. We don't use cash flow mostly. Then we have to discount that free cash flow. We cannot take it as it is. Remember, investment appraisal is whole thing is about discounting. You have to discount your cash flows. So free cash flows are discounted. Why? To find the net present value of the project. So this is the link between the net present value and free cash flow. If you are given free cash flow in the question and they told whether you have to accept the project or not, what that means, they are asking you indirectly to find the net present value of the project. If it's positive, accept. If it's negative, then you have to look at other factors. If they are also not favorable, you reject the project. Understood? So that FCF have to be discounted. Then you find the net present value of the project. Next, relevant cash flows. What is relevant cash flows? Not all cash flows you have to take in your investment appraisal decision. Some cash flows you have to exclude. We'll definitely go in the next slide what are the things we have to exclude, but first of all let us know the definition of relevant cash flows, because in the exam also, to confuse you, the examiner will give you some types of cash flows which you have to exclude, but students they include because they always assume that if it's given everything I have to include. No, it's not like that. Relevant cash flows means only those cash flows which are future incremental cash flows that arises as a direct result of the decision. That means if you are going to go for that project, whatever the cash flow, inflow or outflow that is going to arise because of that investment, because you are going ahead with the investment, only those cash flows are known as relevant cash flows for your investment appraisal decision. It has to be something relating to your future cash flows arising for that project, not something that you do normally, operating cash flows and all. For example, you are paying salary to your staff. That is not any relevant cash flow. That you anyway pay, whether you accept the project or not, whether you don't accept the project, you're normally paying their salary. So that is not taken as a relevant cash flow. Understood? With an example, let me explain what is relevant cash flow. But before that, let us go to the uses of free cash flow. What are the uses of free cash flow? Number one, as a basis for evaluation using net present value techniques. right? Through free cash flow, you know the value of the company. Through free cash flow, you calculate net present value and accept or reject the project. Then indicator of company performance, you see, because basically if net present value is positive means company performance is good. To calculate the value of a firm, right? When we have valuation of firm, there we use free cash flow. This is also used under your acquisition also. When you have to value a company after they have acquired a company, there also you need this free cash flow. So free cash flow is everywhere. You have to know how to use it. It's very easy. Just make some columns, make cash inflows minus cash outflows, discount rate minus initial investment, find the net present value. Next, in valuing potential or share prices also you use free cash flow. And it is as a representation of cash flow available to all capital providers of additional projects. What does it mean? It is the cash that is available for all the capital providers. That means whoever have given you finance, for example, bank, whoever you have taken loan from. So this is a good representation of that free cash flow because it's free. You can use it to pay your loan, to pay your debt, and all those things. Then, from the exam's point of view, what do you need to understand for the free cash flow and how to use it in your answer? In an exam, briefly explain what you have done. What you have done, you have to explain line by line. For example, stating you have ignored a sunk cost will gain you marks. You see, even if I have ignored, you didn't include it in your calculation. Don't just, you have to write the statement. Don't write it without a statement. For example, writing that statement that ignored, because it's a sunk cost, therefore ignored, not a relevant cash flow, you will get 1 mark. Definitely in the calculations you didn't put it, but for writing that statement, you will get marks. So in the exam, the most obvious of the obvious you have to write. Don't think that examiner knows is very obvious. No, you have to write it. Okay, the sunk cost. Sunk cost. What is sunk cost? For example, the cost that you have invested that you cannot recover back. For example, the cost that you have incurred research during your research, they are known as sunk cost. You cannot get it back. The cost that you have spent during promotion and all, you cannot get it back. They are sunk cost. Okay. Then, when assessing a project, you should ignore all financing cash flows. Financing cash flows you have to ignore because we are already talking about investing cash flows. How much of cash inflows and outflows will result because of that investment in the project. For example, the question will say the sales they are going for a project for 4 years and they predict from this project the sales will be the turnover will be for the 4 years this they will give you some amount. The cost relating to this project will be this. The fixed cost relating to this project will be this. So only those cash flows you have to take. Okay, financing cash flows you have to ignore. What is financing cash flow? For example, you have taken a loan. Now you have to pay interest on that. That interest is ignored. If you have to make a loan repayment, ignored. Because those are cash inflows and outflows, no? How do you pay your loan? By giving cash only. How do you pay your interest? By giving cash only. That is not considered as cash outflow in your table, in your chart. Because those are financing cash flows. It has nothing to do with your investment in the project. Even dividends also, when you are paying, they are your dividend cash flows. It has nothing to do with investing cash flows. For example, when you are paying dividend, ignore it. And not only that, also there are tax effect you have to ignore. What is tax effect? For example, when you are taking a loan, you have to pay interest on that, no? And we know that when we take a debt always has an advantage over equity. What is it? Tax effect. Tax effect means they have a tax advantage. When you are taking debt, on debt you have to pay interest. On that interest, because you know interest is tax deductible. Because you deduct your interest before you pay your tax. So higher the interest, lower the tax. You understanding? That means higher the amount of debt, higher your tax, lower will be higher your interest, lower will be your tax. Because a higher amount of tax will be interest will be deducted first, then only you pay tax. You pay first interest, then you pay tax. You understanding? So that's why it is known as tax deductible. There's a tax advantage. You can lower your tax if you have a higher interest. This only comes when you're taking debt, not equity. Equity does not have that advantage because dividend you pay after you pay your tax. So it does not have any tax implications. It does not have that benefit. But interest has the loan. If you are taking loan on that, you have to pay interest. That interest has tax advantage. So that tax effect also you should ignore. The tax saving or additional tax that you have to pay is ignored. Okay, they have given the example also, interest tax relief. It's ignored. Next, why is it ignored? One might ask this question, why it is ignored. The logic behind this why we ignoring is that because all this cash inflows and outflows, whether interest that you had paid, loan or dividend, they have already been taken into account when that discount rate was calculated. Which discount rate? You are discounting your cash flows, right? Your free cash flows, you are discounting it using what discount rate? That discount rate has, how did you calculate that discount rate? Cost of equity plus cost of debt, right? So when you are calculating that cost of cost of debt while calculating cost of capital, there already you have taken that tax effect. You understand? Because when you're calculating cost of debt, we take it, right? Cost of debt into 1 minus T, 1 minus tax. That's the formula. So we have already taken that impact there, and then only we calculated that cost of capital, which we are now using to discount our cash flows. That's why we are not taking it again. Otherwise, it will be that we are taking it twice, the benefit of tax of the interest. While calculating that discount rate, the effect has been taken into the picture. That's why we are not deducting it again. It does not have any impact. Inflation, very important thing, because it can affect your cash flows. Okay, so what do you need to know about inflation from the exam's point of view? You will get a question on inflation. Inflation means they will give you the inflation figure and they will tell you that you have to inflate your cash flows. Okay, but sometimes it's very confusing which inflation to take, which interest to take, which inflation or which interest rate, because students often mix up. There are two approaches to inflation. Okay, students often miss these two things. That's why it's important that you are very clear on this concept. One is known as real method, the other one is known as money market, sorry, money or nominal. I just got confused. Money market comes in hedging. Okay, sorry guys, it's not money market, it's money or nominal. It could be, normally it is known as nominal method. So one is real method, the other one is nominal, or you can say real rate or nominal rate. Which rate to use to inflate your cash flows, you have to understand, because sometimes in the exam you might be given both the rate. One is real rate, one is nominal rate. Okay, but whatever it is, it affects your cash flows, and only one you already have to take, not both. You cannot take both in the same question. It's either real method, either nominal method. What is the meaning of real method? Real method means it's pre-inflation. The cash flows that you are given is without taking the impact of the inflation into the account. Okay, they have not inflated it. So when you are given the cash flows without the inflation taken into account, when you have to inflate it, you have to use the real discount rate, right? You have to use the real discount rate to discount. What is the meaning of nominal? Nominal is the opposite of it. It is post inflation cash flows. That means inflation has been already taken into the picture. They have already inflated the cash flows. Then when you're discounting it, you have to use the nominal discount rate. So in real cash flows, you have to use real discount rate. Nominal cash flows, you have to use the nominal discount rate to discount. That's simple, right? Real for real, nominal for nominal. Okay. So let us explain the formula for inflation, how you have to calculate the real and the nominal. There's a method that links both this real with the nominal. If you know one, you can calculate the other one. For example, you might be given cash flow which is real, but you are given the nominal discount rate. How can you use it? You cannot use the nominal discount rate to discount real cash flows. you have to find the real discount rate. So by having that nominal discount rate, you can find the real discount rate. There is a formula for that, and you need to know this formula. Okay, it's not every time that you have to make use of this formula in the exam, right? Most of the time the discount rate is given, one discount rate only they give, but if in case they give you two discount rates, then you should know how to find out. Okay, R stands for real discount rate, I stands for money discount rate, that means nominal discount rate, and H stands for inflation rate. Remember, you have to have the inflation. You have to have inflation and either nominal or either real. One discount rate you should have. Then only you can find out the other one. It's like you have two variables. Third one is a missing figure which you have to find out. It's okay. So this is the formula, which is known as 1 plus R equal to 1 plus I divided by 1 plus H. Okay. Hence, when you solve it, just multiply the two sides, it becomes like this. 1 plus I is equals to 1 plus R into 1 plus H. That means 1 plus nominal discount rate equals to 1 plus real discount rate plus 1 plus inflation. So you have to multiply the real discount rate with the inflation. After adding 1, of course, you have to multiply the real discount rate with the inflation and minus 1, bring the 1 the other side, and then you will get the nominal discount rate. So they have given you the formula to find both the real discount rate as well as the nominal discount rate. The top one, okay, this one is to find real discount rate, because 1 plus R is on one side, so just bring the 1 the other side. So R equals to 1 plus I divided by 1 plus H minus 1. I hope you can solve, you are good in maths and you will be able to do it. And second one is to find the nominal discount rate, which is 1 plus I. Okay, it's very simple, right? So, and it's given in your formula sheet also. But again, I say it's better to memorize, because who will have so much of time to waste looking for the formula sheet and going through the formula? There are so many formulas there, right? If you remember, it saves your time also. Next, DCF and taxation, discounted cash flows and taxation. So we finished inflation. Now we are moving on to the impacts of taxation. How taxation can affect. There are three important tax effects to consider. Number one, tax payment on operating profit. Number two, tax benefit from tax allowable depreciation. I'm more focused on the second thing, because first one you will be able to calculate. You are given the tax rate in the question, you are given the operating profit, or you can find the operating profit, sales minus cost, your income minus expenses, and then apply the tax on it. It's easy. Second one is an area where you need to work out. Tax benefit from tax allowable depreciation. This you have to find out. This you can find out using two methods. One is known as straight line method, the other one is reducing balance method. Right? It's easy. I think you know it. If you want to know the detail on how to work it out, you have to go to my detailed video. The title of the video was Impact of Tax Inflation in Finding Net Present Value. Yeah, and you will get it under my playlist, Investment Appraisal Lecture. Under that playlist for AFM, you will get the video there. There are two parts to that, part 1 and part 2. Watch both the parts. 3. Tax relief on interest payment on debt. Just now we have covered it. When you pay interest on that, tax relief is there. Your tax is reduced. So, tax relief on interest payments on debt is taken into account by adjusting the discount rate. How do they adjust the discount rate? Earlier we were explaining this, that we don't take the cash flows, or we don't take those tax impact of interest rate payments on debt and all, because it has already been taken into account when we were calculating the discount rate. How? Because when we were calculating the cost of capital or WACC, cost of capital or WACC is the same thing. By adjusting cost of debt, you see, we were focusing on cost of debt. We changed the cost of debt because of the tax. Cost of debt goes down. Cost of debt goes down. Cost of capital also will go down. This is how we adjust the cost of capital. Next, capital rationing. This you must have known what is capital rationing from your financial management also. But here we are going to study one more thing, that is known as multilinear capital rationing or multiple period capital rationing. That means more than 1 year we are having limitations. What is capital rationing first of all? It is where there are insufficient funds to undertake all positive net present value projects. For example, you have 5 projects. All the 5 projects are giving you positive net present value. Now, do you tell me, can you undertake all the 5 projects? Do you have that amount of cash? Everyone, no matter how rich you are, have some limitations to their fund. They cannot just invest whatever, you know. So you need to analyze which one to take, which one to reject. We don't have unlimited funds. We have limited funds. So that's why that term is known as capital rationing. It's limited. We cannot invest in all the net present value, positive net present value projects. It could be due to two reasons. One is known as hard capital rationing. This is also known as external factor. For example, the bank is posing limit that you cannot borrow more than, let's say, 1 million. So that means all the funds you can invest on the projects below 1 million or up to 1 million. More than that, if a project is costing you, you cannot invest on that. So there's a limitation, which is caused by whom? Bank, which is external. So it is known as hard capital rationing. Second is known as soft capital rationing, which is also known as internal factors. Internal capital rationing also you can say. These are these are to do with internal factors inside your organization. That means you are posing your own rationing on capital. It could be for so many reasons. Usually, from exams point of view, this question, capital rationing, comes around 5 marks or 6 marks, asking you some factors, why a company might impose capital rationing, or how they could overcome capital rationing and all. It's very simple, not nothing hard. Okay, because more than this, they cannot ask you also in this area. They will not ask you, okay, list all the hard capital rationing, list all the soft capital rationing. They will not ask you like that. Okay, next. So how do you solve this capital rationing problems? If it is multi-period capital rationing, multi-period means you are having shortage of fund more than one period, more than 12 months, more than 1 year, let's say for 3 years. How are you going to solve it? So multi-period capital rationing are solved through linear programming. I have a video also on all those things in detail. You can go through this. What is linear programming? In linear programming, we make an equation, but we don't solve the equation. We don't have to solve the equation. We just make up an equation. Okay. For example, we say x1 is project 1, x2 is investment in project 2, like that. Because our objective is to maximize net present value. So we make an equation and see whichever equation gives us the highest net present value, we go for that. Okay. And some values they might give you. So a question that they can ask you on linear programming is, they might give you some the variables they will give you. Let's say you have 4 projects and you are making up the equation that x1 is this, x1 plus 2 is like this, equals to, and they will give you that value, that x1 is equals to 0.5 or x2 is equals to 0. From in the question they will give you the value. You don't have to solve the equation. So if they say, let's say you have 4 projects and x1, let's assume x1 is your project 1, and the value that the examiner in the question they have given you is that x1 is 0. That means you're not investing anything in x1, project 1, zero investment. And in project 2, let's say the value they have given is 1. That means you're investing entirely on project 2, and they will give you the net present value. So they will give you like this 2 3 combination, and they will give you different net present value. So the combination which is giving you the highest net present value, you have to go select that one. Okay. Number 2, single period capital rationing. In AFM, I have not seen a question where they have a single period capital rationing. The focus is more on multi-period capital rationing. That means the focus is more on linear programming, because the second one is asked in financial management, but in AFM it is more on linear programming. Okay, but still it's better to know because it's financial management. So for AFM it is considered as an assumed knowledge. That means whatever is taught in financial management, you should know it in AFM. Okay, whether it comes or not. If you know it, it gives you a positive advantage over others. So don't think that because I finished it in financial management it's not important, it will not be asked in AFM. What if? You never know. So single period capital rationing, how do you solve this? Here we have to calculate a thing known as profitability index. You have to calculate. It is not in multi-period capital rationing, no, okay? Only for the single year when you're having a limitation. Let's say in this year, the limit to the labor hours is 5,000 hours. Okay, so it's a limit. So you have to calculate a profitability index for that. What is profitability index? And based on that profitability index, you rank whichever is giving you the highest profitability index. That will be one. Then the second, third, fourth, like that you will be giving ranks, and based on that only you will be investing. Okay. So the formula is this. It is equal to net present value divided by investment. That means how much of net present value you are going to get for that investment, for investing in project 1, 2, 3, 4, like that, based on the ranking that you are given. If it's first rank, that means that should be your first priority. You are going to invest on that, then second, then third, and whatever is remaining, finally, you will be going investing in the last project. Okay. So make sure that you know how to calculate profitability index, net present value divided by investment. You can use your Excel to do all these calculations and all in AFM. Okay. A lot of students, another thing I want to clarify here itself at this point, whether to use Excel or Word, MS Word, to do questions in AFM. So it depends. If a question is, let's say, in a 50 marks question, you are supposed to write a report, and the numbers are very short. You just need that small amount of figure and all. Some calculations you need to do. Definitely in MS Word, you cannot do calculations. You have to do it in Excel because Excel has that formula for you, right? Inbuilt formula. You just write sum or divide, it comes automatically. You can even copy it to the other sheet. That's why Excel is faster. So I always say do calculations in Excel, okay? And if you're making a report, let's say in section A for a 50 marks question, just copy paste that figure after you've calculated it in your report. Okay, problem solved. Or you can use a calculator also to do the formula. But if the formulas are pretty big enough, for example, some calculations you need a lot of space, like when you're calculating net present value and all, those you can keep it in Excel, it seems. Okay, Excel only. Because for net present value, you have to calculate sales, variable cost, all these calculations, only heavy calculations are needed. And you have to make it in a form of a table. Year 1, year 2, year 3, like this. So you can, for those you can use Excel. Keep it in Excel only. Okay, but wherever like this profitability index or small amounts you have to calculate, some ratios you might have to calculate and put it in MS Word. You do it in Excel, copy paste it in MS Word. Or you can use your calculator also, find it and do it in MS Word. But I always prefer Excel over calculator because Excel has that advanced function and all, and it calculates much faster than the calculator. Because calculator you cannot copy paste. You know, every year you have to calculate. Every time you have to calculate. For example, if you are calculating, if you have to discount for 4 years, every year you have to, for every year you have to write again, erase again, write, if you are using calculator. But if you are using Excel, you only write it once and then copy paste to the other cells. So isn't Excel faster in that way? So you have to be smart enough to use techniques and minimize the time that you are taking to do your calculations. Okay, I'm not saying don't use calculator, but whatever is faster for you, use it. That's what I meant. Next, capital rationing. PI means profitability index. Okay, remember there's a limitation to this also. You just cannot use profitability index for any investments. Only for those investments which are divisible you can use. And no projects are, and also for those projects which are not mutually exclusive. Otherwise, you have to use trial and error. For example, if you're finding the profitability index as 2.5, 3.5, you cannot use profitability index for the rank. It has to be a whole number, 2, 3, 4, like that. Otherwise, you have to use trial and error. Okay, but mostly this part will not come in AFM. I have not seen a question in AFM regarding this. So you don't have to worry about it. But yes, your linear programming, you have to work out. And mostly it's asked for around 3 marks, up to 5 marks only. Not more than 5 marks, they will not ask a question on linear programming. Okay, that means inside capital rationing, more than 5 marks or 6 marks, they will not ask you a question. So you don't have to worry too much about this. Just knowing it briefly is enough. Dual values. What are dual values? Dual values are the change in the objective function. from having one or more less unit of scarce resource available. They can be used in capital rationing too. Calculate the impact of raising funds to facilitate further investment. Number two, calculate the impact of diverting funds away from the current projects to newly discovered ones. Okay. Even this dual values and all also is not asked in AFM. So what you need to focus is only on linear programming from AFM's point of view. But if a financial management student is watching this video, then please you have to go through all this dual values and profitability index and all. Okay. Next. Wow, this is a very interesting thing. IRR and MIRR. This is the easiest of the slot. I don't think anyone will have a problem with this. What is IRR and what is MIRR? IRR, you know from financial management. MIRR is modified. That means definitely it will be something new only, right? That means there are some limitations of IRR. That's why they have introduced this MIRR. So IRR is the rate at which net present value is zero. You have to find that interest rate or rate of discount where net present value is zero. And how do you find this IRR? You can use it by interpolation or extrapolation. Okay, linear interpolation or extrapolation. This is the formula for IRR. Okay, let L plus NL divided by NL minus NH into H minus L. L is the lower rate of interest. So that means you are adding the lower rate of interest plus inside the bracket. Lower rate of interest divided by, sorry, not lower, NL. Net present value, the lower rate of interest divided by net present value, the lower rate of interest minus net present value, the higher rate of interest into H minus L. That means higher rate minus lower rate. Okay. Let's say you one discount rate you'll be given. Okay, don't worry. For example, you have used discount rate of 5% and you got a positive net present value. Okay. Now you have to find IRR. How are you going to find IRR? Which rate are you going to use? Are you going to use a discount rate more than 5% or less than 5%? Because at 5% you are getting a positive net present value. So if you are getting a positive net present value at 5%, you have to use higher discount rate. Higher discount rate. Okay. Because a higher discount rate will reduce your net present value. Okay, so you might be thinking, how do I know which discount rate will give me zero? You don't have to worry about it. You have to take any discount rate you can take. It's fine. You can take 6%, 7%, 8%, 10%. It does not matter. Okay, take any discount rate. Okay, take any discount rate, but it has to be higher than 5%. That's the only goal. It could be 6%, it could be 7%, it could be 10%, 20%. Okay, whatever it is, take it and calculate net present value based on that. Okay, so it's better that you take a bigger amount, because if you take by 6, let's say you are taking a discount factor 5% and you got a positive net present value of 1000. So if you are using 6%, there are chances are very unlikely that you are going to get a negative or a zero. Still you will be getting positive net present value, but a smaller amount. So take a bigger percentage. If you are take at 5%, if you are getting positive, let's say you take 10% now. So there are high chances that you are definitely going to get a net present value, a negative net present value or zero. Even if you're not getting a negative net present value, don't be sad. Still you can use that second discount rate to calculate IRR. Okay. So based on that, calculate, and using this formula, you will get an IRR. Okay. Next, modified IRR. What is modified IRR? Here, and this is modified IRR is often asked as a part of a question. Part of a bigger question. Okay, it's not a question on its own. A big question will not be asked. They might ask a question for 2 or 3 marks. Okay, MIRR, the difference from IRR is that this is reinvested at the firm's cost of capital. Okay, that means whatever the cash you have, inflow and outflow, when you have to discount, you are discounting it by using cost of capital. This is very similar to net present value. That's why preferences are given more on MIRR. For example, in the question, if you are asked, Let's say if you are basing your decision based on IRR and MIRR. Okay, you have two projects, A and B. Okay, using IRR, your decision is different. You are choosing B. Using MIRR, you are choosing A. So preference should be given to which one, IRR or MIRR? Preference has to be given to MIRR over IRR. Okay, I'm giving you the conclusion. I'm giving you the answer that you have to write in the exam. Why MIRR? Because this goes in line with your net present value. That's why. Because net present value means what? Positive net present value means maximization of shareholders' wealth. Yesterday I told you that the financial manager's prime responsibility is to maximize shareholders' wealth. That's why when a project is positive net present value, we accept that project because it maximizes shareholders' wealth. So same MIRR also does the same thing because it is reinvested at the cost of capital. And we discount cash flows also at cost of capital to find net present value. So that's why MIRR and net present value goes hand in hand. They go together. So you have to, preference has to be given to MIRR. Okay. IRR on the other hand, they take IRR. They don't take cost of capital at reinvested rate. They take IRR, internal rate of return to discount. And if you have ever got an answer using MIRR and IRR, you know this. Definitely you should know this. MIRR will always give you the lower figure. For example, if you're finding in terms of percentage, MIRR will be the lower one compared to IRR. Always, it should be like that. You can never get an MIRR higher than IRR. Okay. Next, how do you calculate MIRR? The formula is given in your formula sheet, but again, I'm explaining you here because I always believe in knowing the formula rather than referring to the formula sheet. Okay, it is present value R divided by present value phi into 1 minus into 1 to the 1 divided by n, that means to the power 1 over n, into 1 plus RE minus 1. Okay. Okay, I didn't explain you the figure. What is PVR? That means present value of return. Present value of return means what? All your cash inflows. Present value of your cash inflows will be on the top. Divide by present value of I means investment. Investment, there is only one outflow, that is your investment. So present value of investment. So present value of your return divide by present value of investment. Return means all your cash inflows. Divide by present value of investment. To the power. Okay, it's not into, sorry guys, I told into before. It's to the power 1 divided by n. 1 divided by number of years. N is number of years. Into 1 plus RE minus 1. Okay. RE is your cost of capital. R is your cost of capital. So cost of capital they will give you 1 plus cost of capital minus 1. Okay. Next. So this is the comparison overall between IRR and MIRR. How does MIRR solve the problem which IRR was not able to solve? Number 1, eliminates the possibility of multiple rates of return. Guys, using IRR only works when you are having a cash inflow in one sign. For example, after outflow, initial investment, all your cash inflows are positive. You are having inflows. That means all are positive sign after a negative sign. There IRR will work because you will only have one IRR. But what if your sign keeps changing? One year you are having a cash inflow, second year you are having a cash outflow. So it's like inflow, outflow. You are having positive, negative. You will have multiple IRR. So MIRR solves that issue. Using MIRR, you will not have multiple MIRR, only one MIRR. So MIRR solves that issue. It eliminates that problem of multiple rates of return. You need this answer to write, guys, when you have to compare between MIRR and IRR. So make sure that you know these points, the 3 points at least. Okay. Second, addresses the reinvestment issue. What is the reinvestment issue? IRR rate only, and that is based on some trial and error, some interpolation rates, which is not so suitable. But MIRR is not like that. MIRR is Reinvesting at what rate? Cost of capital. Cost of capital. So cost of capital, net present value is also we are finding using cost of capital. Both are cost of capital. So it solves that issue also. Third one, MIRR is unique. Because MIRR is unique, it can be used to compare projects. You can compare projects because they will not have multiple rates of return. It is taken at cost of capital, the reinvestment rate, and also you can use to compare projects easily from one project to another's. IRR you cannot compare like that. For example, one project is giving you multiple IRR, another project is giving you only single IRR. How can you compare the two projects? Which one is better? Okay, so comparison wise, investing wise, the reinvestment issue, and also the multiple reserve return. In all these three issues, MIRR is leading over IRR. Coming to the next one is discounted payback period. What is discounted payback period? You know payback period? Same. This is discounted, that's it. They have taken the time value of money into the account. That's the only difference. Okay? But the definition remains the same of the payback period only. It is the length of time that you are taking to recover your cash outflow, your initial investment. Okay, for example, your initial investment is 5 million. Now, how many years you are taking to recover to get back those 5 million? That is known as discounted payback period. Discounted because you are discounting it. You are taking the time value of money. But in payback period, the normal payback period, what was the issue? It didn't take the time value of money. And also in payback period, after you started getting the positive cash inflow, you are ignoring all the other years after that. You are not taking the cash flow after the other years. Once you start getting you recovered your initial investment. After that, beyond that, you're not taking care of the other cash flows. For example, you have a project for 5 years. Okay, definitely in year 0 is an initial investment outflow. First year and second year. In second year only you recovered your initial investment. So your third year, fourth year, fifth year, you are ignoring. You're not taking those cash inflows into account. Right? That's why this discounted payback period came into the picture to solve that issue. Next, duration. So that's it. Only about discounted payback period. What is duration? Duration is a term which is very heavily used in AFM. This is often asked. Right? What is duration? It is the average time to recover the present value of the project. Please understand the difference between discounted payback period and duration. They are not same. Here they are not talking about initial investment. Here they are talking about the present value. I have highlighted it in bold so that you see the word present value. Not net present value, present value. That means all your inflows, cash inflows. Present value of the cash inflows. So this measures the average time to recover the present value of the project if discounted at the cost of capital. Make sure that you know how to calculate duration. You should know it. It's not given here. I didn't, okay, but questions and sums and all using duration is there. In detail lecture if you want to see in my playlist investment appraisal lectures, under that you will get duration. Coming to this, projects with high durations are relatively high risk projects. So remember high for high. Definitely no one wants to recover their present value for 5 years, 10 years like that. They definitely want to recover it as soon as possible. That means they always prefer projects with lower durations. Because lower durations will give you low risk, right? Because it's common sense. Like even if it's we who are investing, we always want to recover as soon as possible. We want to get our cash inflows as soon as possible. We don't want to wait for a long time to receive our cash flows. Okay, because it then becomes very risky. So high durations, high risk. Coming to the end of this, financial reporting and investment appraisal. You have to take care of certain things when you're answering also. Okay, so from exams point of view, when evaluating capital investment projects as well as the impact on the shareholder value, okay, you have to talk about these things. What are the impact on the share price? You have to write this in your answers. Okay, when you're writing a report and all, other than same positive net present value, that's why we are accepting the project. No, you have to talk about these things as well. It's a report you have to write. Other than Positive net present value also you have to write. So these are the things that you have to write. Share price. What is the impact of the share price? If you are investing in that project, what could be the impact on the share price? Next, gearing. How can it affect your gearing? Will it increase your debt? For example, if you have to take that project, do you have to take more loans because you don't have funds to invest to take on that project? So that will increase your gearing. All those things you have to take care of. Next, ROCE, return on capital employed. What will be the ROCE for the shareholder? Next, earnings per share. How it can affect your EPS. Okay, this needs to be considered in your answer. Moving to the areas for the consideration. Now there are 5 areas that you need. Number 1, timing differences. Okay, what are the timing differences between cash flows and profit? We know that cash flows and profits are not the same thing. Okay, there are differences. You have recognized a revenue, that means your profit will go up, but you still didn't receive that cash from your customer. So if the timing difference is big, number 1 is risky also. Okay, because you still didn't receive the cash flow. So it's not good, which is not good for the overall. And also it affects key ratios when you're calculating ratios and all. Okay, so one ratio which I can think of right now, yes, working capital ratio. So in terms of liquidity, it will show that you are not liquid enough. Why? Customer didn't pay on cash. It's sales on credit. So you're not receiving cash. That means your assets will go down. So your working capital will go down. That means you are suffering. Right? Your working capital ratio is not showing that you are in a good liquid position. But coming to the profitability ratio, there you have recognized revenue. So there profitability ratio will show you. For example, your net profit margin or gross profit margin will be higher. So in terms of profitability, you are doing good, but in terms of liquidity, you are not doing good. It's not consistent with each other. It's contradicting. So that timing difference you have to see. If the timing difference is very big, then it can affect your key ratios. But if the timing difference, let's say it's 1 month, 2 months, it's small. So then that impact is not so much. So lesser the time between these two, better it is. Dividend policy. And remember, this areas for consideration that I always discuss in my videos, this helps you to write your theory parts. Dividend policy. For example, if you have to invest on a project, you have to see, does it mean that you have to cut on your dividends? Because that fund is limited. You can only go for one. You have an opportunity cost for everything. You cannot pay dividend also. You cannot go for investment also. Either you go for that investment, that means that cash you are having, you are using it for investment. So you cannot pay to your shareholders. You have to cut on that dividends to increase that fund for your investment. This is not good sign. It means it's giving a negative signal to the market because it can affect your return on capital employed. Okay. Second, share prices may fall. Yes, because shareholders will be unhappy. They will not be satisfied if their dividends are cut. Hence, share prices may fall because it's a negative signal to the market. No, so share prices will fall. Gearing levels. How it can have an impact on the gearing levels? You see, usually gearing levels and all, they are based on market values, right? But equity value we calculate based on our net present value of the projects, because when you are calculating net present value of the project, it is built into the calculation of the value of the equity also. Okay, for example, if you are getting that net present value, only we consider it as a value of the equity. So that is based on our calculation. So if that changes, gearing level will change. You understanding? So it can have an impact on the gearing level also. And finally, right issue. Okay, So research is showing against the theory. In theory, it is something else, but research is showing that it is often unfavorable reaction to right issue. There is often unfavorable. Why unfavorable reaction to right issue? Because it lowers the price even further than that is expected. They expect that this much price will fall, but actually, in reality, the price falls much below that. So they consider it as an unfavorable. Okay, because when you have to go for investment, when you have to invest on a project, you might have to go for a right issue because you want fund, right? You want fund for that. So if you are going by right issue, it's not shown as a it. You often get unfavorable reaction from other people. So these areas you need to consider before going for which investment you have to go for. Whether if you go for that investment, will it affect your? Does it mean that your dividends have to be cut? Does it mean that your share prices might fall? Does it mean that your gearing level will increase and it means you are more risky now? Does it mean that you have to take a huge amount of loan now? Because huge amount of loan, with that comes burden of paying interest and everything. So all those things you have to take care of. So that's it, guys, for investment appraisal. Tomorrow, that means the upcoming lecture will be talking about international operations and international investment appraisal. It's one topic only, okay? We are talking about international investment appraisal. Today we talked about local investment appraisal. That means in your home country. We didn't go to the international aspect. So when we go to the international, we have to talk about foreign exchange risk, to convert the foreign currency into the home currency, then find the net present value. All those things we are going to learn. Okay? Because in the question, it's not only that you will be given the local domestic investment appraisal. Most of the time I have seen they might give you an international investment appraisal also. That means you have to find net present value, but it might be in a different currency. You might first have to convert to your home currency and then you have to use discount factor and then find the net present value. So that we are going to cover in tomorrow's lecture. So see you till then and subscribe to my channel if you haven't subscribed to my channel. I'm about to reach 1K subscribers soon. And thank you guys for supporting me so much. It's going to be 1 year soon. And I'm planning to come live if I reach 1K subscribers and give you some advice and tips regarding ACCA before your exams come, of course. Yeah, September exams. So see you till then and take care. And I'm hoping for the 1K subscribers soon. Till then, take care. God bless you. And see you in my next video.